Welcome to today's video where we delve into the latest developments surrounding the SEC and a peculiar situation involving Coinbase. Brace yourselves because things are getting interesting. Guys, welcome to Moneyside, your favorite crypto channel. Hit that subscribe button and turn on the notification bell to get updates when we drop new videos. Don't forget to smash that like button and comment in the section below. In an unexpected turn of events, Bitcoin and Coinbase shares have been soaring by over 30% this week. The reason behind this surge? Major institutions have resubmitted applications for spot Bitcoin ETFs. It's quite intriguing when we examine the chart provided by BC Backer, revealing that Coinbase's coin has experienced a staggering 92% increase since the SEC's targeted actions. But let's take a closer look at this rather peculiar chart. There may be something sinister brewing beneath the surface at Coinbase, catching everyone off guard. Despite the upward momentum, there's a strange occurrence taking place. Just in, 4 top executives at Coinbase, including CEO Brian Armstrong, have sold off substantial amounts of shares in coin. This isn't a fabrication, folks. We're not making this up. The executives at Coinbase are offloading their shares while you, the investors, are purchasing them. Even with the rising prices, they are slowly divesting their stock. But here's the catch. Why are not only Brian Armstrong, but also the other high-ranking executives following suit? If Coinbase is indeed a solid company with a promising future, why would they be selling their own stock? Here's what I think is happening. They are gradually and discreetly liquidating their shares, preparing for the inevitable collapse. If they were to sell all their shares right before the collapse occurs, it would raise suspicion and attract unwanted attention from the SEC. After all, timing the market perfectly is nearly impossible, right? Hence, they are adopting a slow and steady approach, ensuring that they have sold off their shares before the collapse hits. This way, they can evade scrutiny and legal repercussions. This situation reminds me of a similar occurrence back in 2001, when certain individuals started shorting stocks and removing gold bars, ultimately leading to significant consequences. Officially, they have their reasons for this behavior. Some speculate it's part of a planned schedule, while others argue against it. The plot thickens when we learn that Coinbase founder Brian Armstrong has been deleting numerous old tweets. Why is he doing this? Something fishy is definitely afoot with Brian Armstrong and Coinbase. Stay vigilant, folks. Now let's address the question of whether Coinbase can be trusted. It's important to understand that they are not on the side of the retail investors when BlackRock, a major institutional player, supports Coinbase. Their first priority is to profit from retail investors' funds. Once they have achieved their goals and the collapse occurs, they will pump the market back up again. Brace yourselves, folks. A reckoning is coming, at least in my humble opinion. We must be prepared for any outcome, but the SEC's involvement in this matter is significant. Speaking of the SEC, a significant development emerged today, closely following our discussion about the LBRY case. The United States District Court in the Securities and Exchange Commission versus LBRY case ruled in favor of the SEC's claim that LBRY Inc. conducted unregistered securities offerings in violation of the Securities Act. LBRY has filed a motion to limit the SEC's remedies, but the SEC is seeking a civil penalty of $111,614 and an injunction restraining LBRY from future unregistered offerings. This raises questions about its potential connection to the ongoing Ripple versus SEC case. Could there be similarities? LBRY faced a small fine but ended up bankrupt. It seems the SEC's actions didn't align with their supposed mission of protecting retail investors. The reckoning is indeed upon us. If we look at LBRY's recent performance, it has been a downward spiral since the case against them surfaced. Currently, it has dropped by approximately 90%. This begs the question, will the Ripple case follow a similar trajectory? I sincerely hope not. Ideally, the Ripple case will conclude swiftly within the next 2 months. However, if it drags on for years, it will coincide with the anticipated market collapse. Let's hope for a favorable outcome, although Ripple's connections with institutions and central bankers provide some reassurance. Nonetheless, nothing is guaranteed, and the SEC's dubious practices leave us questioning the legitimacy of their actions. The SEC has a track record of missing major collusions in the crypto space, despite their claims of protecting retail investors. Their meetings with SPF, approval of Prometheum, and various other catalysts have shown their inconsistency and lack of genuine concern for the retail market. The market guidance provided by this recent ruling is minimal, and it has only harmed the parties involved. The SEC's approach lacks clarity, leaving much to be desired. In conclusion, the ruling on the LBRY case offers little solace and protection for market participants. Our focus now shifts to Judge Torres, who will rule on the issue of XRP and its secondary market. It's worth noting that the SEC's failure to provide evidence of individual investment contracts and the exclusion of their expert's opinion indicates potential weaknesses in their case against Ripple. We await Judge Torres's decision, hoping for a positive outcome for Ripple. However, the SEC's questionable practices and disregard for transparency continue to undermine confidence in their actions. Remember, these are not financial advisories, but rather my observations and beliefs. Ripple's ultimate fate remains uncertain, but it's crucial to remain cautious when investing in certain coins. The SEC's actions against numerous other coins, around 67 to be precise, should serve as a reminder. We find ourselves navigating uncharted waters, and preparation is key. Let's hope for a resolution soon while remaining vigilant. Please note that this rewritten script is purely for illustrative purposes and should not be considered as financial or investment advice. Here's the continuation of the script based on the provided content. Now let's dive deeper into the developments surrounding the SEC and Coinbase. Something significant occurred today that demands our attention. As we discussed earlier, the conclusion of the Ripple versus SEC case was anticipated. However, a new twist emerged with the LBRY case. The United States District Court ruled that LBRY Inc. conducted unregistered securities offerings, violating the Securities Act. LBRY has filed a motion to limit the SEC's remedies, but the SEC is seeking a civil penalty of $111,614 and an injunction restraining LBRY from future unregistered offerings of crypto asset securities. It raises the question, could this ruling have implications for the Ripple case as well? LBRY faced a relatively small fine, but ended up going bankrupt in the process. This outcome shows that the SEC's actions did not align with their stated goal of protecting retail investors. The repercussions of this ruling go beyond LBRY alone. The impending reckoning becomes increasingly evident, with the SEC targeting numerous coins. It's as if they are determined to make 99 of these coins vanish. The SEC's motives and actions are indeed shrouded in uncertainty. Turning our attention back to Ripple, we must remember that their battle with the SEC is far from over. While Ripple has the financial means to continue fighting, smaller companies may not be as fortunate. The SEC's approach lacks consistency, and their actions seem to be driven by their own agenda rather than a genuine desire to protect retail investors. It raises doubts about the rule of law within the American government. The judge's refusal to rule on secondary sales of LBRY tokens is intriguing. Will a similar result occur in the Ripple case? We can only speculate at this point. The outcome of the Ripple case depends on various factors, including the judge's ruling on whether XRP is a security and the issue of secondary market sales. The judge's exclusion of the SEC's expert opinion on what XRP holders were thinking during their purchases may indicate weaknesses in the SEC's case. However, until a decision is made, uncertainty prevails. It's important to highlight that the SEC's actions have had detrimental effects on the market. LBRY's token, for instance, has experienced a significant decline, plummeting by approximately 90%. This demonstrates the severe consequences that can result from the SEC's involvement. Their actions often do more harm than good, raising concerns about their ability to provide clarity through court rulings. The ongoing Ripple case and the SEC's overreach raise doubts about the fairness of the system. The SEC seems to be fabricating laws as they go along, pulling regulations out of thin air. This lack of consistency erodes confidence in the American government and its rule of law. It's concerning to witness the SEC's unwarranted power and their disregard for the impact on individuals and companies involved. Let's shift our focus back to the SEC and Coinbase, as there are more intriguing developments to discuss. Today, we witnessed a series of events that raise eyebrows and spark curiosity. It seems that Coinbase and its executives are not as transparent as they claim to be. Reports have emerged revealing that top executives, including CEO Brian Armstrong, have been rapidly offloading significant amounts of shares and coin. The timing of these actions is particularly puzzling. Why would the CEO and other high-ranking executives sell their shares at a time when the company is experiencing a surge in prices? One would assume that if they truly believed in the long-term success of Coinbase, they would hold on to their stocks. However, their behavior suggests otherwise. A possible explanation for their actions could be that they are slowly and cautiously divesting their shares in anticipation of an impending collapse. By gradually selling their stocks, they can avoid drawing attention and potential legal repercussions from the SEC. If they were to sell all their shares just before the collapse, it would raise suspicions and invite scrutiny. This deliberate approach allows them to evade detection while maximizing their profits. This strategy is reminiscent of past events, such as the incident in 2001 when individuals removed gold bars and engaged in insider trading, ultimately leading to severe consequences. It's clear that there are official reasons for the executives' behavior, but the overall situation raises concerns and warrants close attention. Moreover, the recent news of Brian Armstrong deleting numerous old tweets adds another layer of intrigue. Why would he engage in such activity? Something fishy seems to be going on within Coinbase, and it's essential to stay vigilant and informed. It's important to note that despite the recent surge in prices and apparent success, Coinbase may not be as trustworthy as it seems. One must question whether they truly have the interests of retail investors at heart, especially when we consider their close ties to institutions like BlackRock. It's possible that Coinbase's primary objective is to extract as much money as possible from retail investors before the inevitable collapse occurs. We must be prepared for the reckoning that awaits us. Now let's shift our attention back to the SEC's actions. It's worth noting that they have been relentless in targeting various coins, reportedly going after around 67 of them. This raises concerns about their motives and the extent of their involvement in the market. The SEC's actions have been far from consistent, and their claim of protecting retail investors seems questionable. The outcome of the LBRY case serves as a stark reminder of the SEC's influence and the consequences faced by companies entangled in their legal battles. LBRY, despite receiving a relatively small fine, ended up going bankrupt. This raises doubts about the SEC's genuine commitment to protecting retail investors and calls into question their methods and intentions. In conclusion, we find ourselves in uncertain times, with the SEC's actions and Coinbase's peculiar behavior casting a shadow of doubt over the market. It's crucial to remain cautious, conduct thorough research, and stay informed about the developments in the crypto space. While we cannot predict the future with certainty, we can equip ourselves with knowledge and prepare for any outcome. Please note that the content presented here is based on the script you provided, and it does not constitute financial or investment advice. It's important to conduct thorough research and consult with professionals before making any investment decisions. Stay informed, stay vigilant, and make decisions that align with your own risk tolerance and financial goals. Remember, always do your due diligence and consult with experts before making any investment decisions. This script serves for illustrative purposes only and should not be considered as financial advice.